Ladies and gentlemen, good day and welcome to JK Tyres & Industries Limited Q2 FY23 earnings conference call hosted by ICICI Securities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Basudev Banerjee, Vice President at ICICI Securities Limited. Thank you and over to you, sir.
Thanks, Seema. We have with us the senior management of JK Tyres & Industries Limited, represented by Mr. Anshuman Singhania, Managing Director, Mr. Arun Bajoria, Director and President, International Business, Mr. Anuj Kathuria, President, India Business, Mr. Sanjeev Agarwal, Chief Financial Officer, and Mr. A.K. Kindra, Financial Advisor. So, thanks to JK Tyres management for giving us the opportunity to hold the call. Over to you, Mr. Bajoria, for your initial comments, and post that we'll take the Q&A. Thanks.
No, so this is the opening remarks by Mr. Anshuman Singhania, Managing Director of the company. So he will start, and then Mr. Bajoria will add to the other aspects of the business. So over to you, Anshuman ji.
Yes. So, good afternoon, everyone. A very warm welcome to JK Tyre Quarter 2 FY23 earning calls, and thank you for all joining us today. I am Anshuman Singhania, the Managing Director. I have with me Mr. Arun K. Bajoria, Director and President International, Mr. Anuj Kathuria, President India, and Mr. A.K. Kindra, Financial Advisor, and Mr. Sanjeev Agarwal, CFO of the company. At the outset, I would like to thank all our customers, dealers, bankers, and stakeholders for reposing trust and partnering in JK Tyre's growth story. We are proud to share that our products are innovative, efficient, and sustainable in the era of decarbonization and digitalization. In the times of uncertainty, we have robust products, business systems, and processes well suited for the VUCA world. During Quarter 2, the company has registered an impressive top-line growth of 26% at rupees 3,764 crores, which is the highest ever sales for the quarter. Our strong presence in OEM and replacement markets enable us to leverage on the buoyancy in the tire sector. On the strength of our innovation, high performance, diverse product portfolio, and high brand visibility, our ever-growing association and strong collaboration with OEMs is continuously resulting in new vehicle launches rolling out on JK Tyre. We continue to achieve robust volume growth in the domestic market across major products, that is commercial passenger tire segments. During the quarter, OEM offtake improved sharply post easing in the semiconductor supplies, festival season, and good traction in the economic activities. Furthermore, exports have made a significant contribution to our revenue growth despite geopolitical and economic slowdown challenges. We are confident that the strength of our brand, products, and distribution network will enable us to sustain the growth in all the market segments. In Quarter 2, the automotive industry continued its robust performance. CV segment continued to gather momentum on back of replacement demand led by higher fleet utilization, government infrastructure push. CV growth is expected to trend further up in the near to medium term. In the passenger space, strong performance towards personal mobility, inclination towards SUV segment, and ongoing festive season is driving the growth in the PV category. The order book remained healthy for all the major PV OEMs. All these developments in the automobile industry will drive robust demand both in the replacement and OE market for the tire industry in India. To capitalize on the growth opportunity, we are unleashing our capacity wherever possible. The already announced capacity expansion capex in PCR and TBR tires are under implementation stage and progressing well. To strengthen our product portfolio, we have recently added new range of tires for the commercial vehicles, that is Jet Steel JDH XM and Jetway JUC XM, in order to ensure long-term benefits to our customers. In our EV journey, we have recently unveiled the complete range of EV tires. These tires, namely Jetway JUXE, are designed to meet the stringent performance needs of EV trucks and buses and also LCVs, and Ranger HPE for passenger cars and SUVs. Raw material and other input costs have started softening after a long spell of unprecedented increase, which is likely to improve the margins in the medium term. We are extremely proud to share that the JK Tyre has been assigned best-in-class rating by CareEdge on ESG parameters. The high rating is primarily driven by leadership, performance on environment, social and governance pillars. This recognition is a testimony of our unwavering commitments and responsibilities towards conserving environment and serving the society needs. It is highly satisfying that we keep sustainability at the heart of our growth journey. We are committed to the goal of being green and clean company with sustainable use of green energy and reduction on fossil fuel dependency. We stand committed towards the betterment of our people and the largest community. We will continue to continue to provide support through our well-structured CSR programs. We follow global best practices and uphold the highest standards of corporate governance and compliance. We are proud and honored to be featured amongst the iconic brands of India 2022, a recognition received for the fourth time in a row from the Economic Times Iconic Brand of India. Further, our manufacturing units have continuously been receiving many accolades. To name a few, our Chennai tire plant received the CII National Energy Leader Award 2022 for the 5th consecutive time. Vikrant tire plant won the Energy Efficient Unit Award from CII. Kankroli tire plant was awarded the CII National Award for Excellence in Water Management 2022. Now I would request Mr. Arun Bajoria ji to talk about the performance of JK Tornel, Mexico.
Thank you, MD sir. JK Tornel, Mexico continued to perform well in terms of overall revenue and profitability. During the quarter, JK Tornel achieved highest ever turnover of Mexican pesos 1,830 million, which is equivalent to rupees 721 crores, as compared to Mexican peso 1466 million, equivalent to 542 crores, an increase of 25% in constant currency. Operating profit of Mexican pesos 164 million, equivalent to rupees 65 crores, is an increase of 13% in peso terms on year-on-year basis. There has been significant improvement on all operational parameters, with plants running at more than 90% capacity utilization and volumes increasing quarter-on-quarter. JK Tornel continues to remain the largest tire supplier to all the mass merchandisers in Mexico, vis-a-vis Walmarts, Sorianas, Chedrauis, Electra, Coppel, Casale, Suburbia, and Commercial Mexico. JK Tornel continues to command highest PCR market share in the replacement market and holds the leadership position for online sales in Mexico. We are happy to share that JK Tornel has secured 4-star rating for British Council's Sword of Honour. Since the acquisition of JK Tornel, there has been a significant growth in business operations and has resulted in yielding multifold value creation for its parent company. Thus, it has been a successful strategic investment for JK Tyre. Now, I would request Mr. Agarwal, the CFO, to brief about the financial performance of this quarter.
Thank you, sir. Let me briefly highlight the financial performance in Q2 FY23. The consolidated sales were recorded at rupees 3,764 crore, which is the highest ever quarterly turnover recorded in the history of the company. The corresponding number was rupees 2,998 crore in Q2 FY22, registering an increase of 26% on YOY basis. The average capacity utilization was 85%, with radial capacity at even higher utilization level during the quarter. Overall volumes witnessed double-digit growth over the corresponding quarter. Export revenues from India were recorded at rupees 514 crore in Q2 FY23, vis-a-vis rupees 454 crore in the corresponding quarter, which is up by 13%. Profitability at EBITDA level in Q2 FY23 was recorded at rupees 305 crore as against rupees 303 crore recorded in Q2 of FY22. Operating profit margins were recorded at 8.1%, which is marginally better as compared to previous quarter. Cash profits for the quarter stood at rupees 196 crore and profit before tax stood at rupees 74 crore. The balance sheet of the company is quite healthy and leverage ratios remain within the acceptable levels, although we are fully committed to deleverage our balance sheet and bring down further the debt to EBITDA ratios and other debt to equity ratios through reduction in long-term borrowings going forward. We have already circulated our earnings presentation, which is available on our website as well as on stock exchange websites. Now we are open for the question and answers. Thank you.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Thank you. We take the first question from the line of Ashutosh Tiwari from Equirus Securities. Please go ahead, sir.
Yeah, hi. Congrats on decent numbers. So, firstly, on the export side, it seems to have grown quarter on quarter. So, which geographies are doing well for us?
Can you please be louder slightly because there was we can't get the point. You are talking about exports. So what?
It seems to have grown quarter on quarter despite a global issue. So which geographies are doing well for us? That's the question.
Okay. So basically, we have been exporting to more than 105 countries globally, and we have been exporting to North America, Latin America, and Europe, Middle East, and other countries. So North America, as we have discussed earlier in the previous calls, that is providing a good opportunity for our products. So probably that is the one which is contributing the most in the exports increase.
Okay. And secondly, on India side, how was the demand in terms of volumes on a quarter-on-quarter basis across segments like truck and PCR and all?
Yeah, so on the outlook of the industry, the CV demand looks to be coming in strong and expected to have a structural upcycle over the near to medium term. That's what we are looking at. And then even in the PV segment, passenger car, we are seeing that tapering off of the chip shortage is waning off, but it is still there. And we are hoping that the tractor segment should do well on the onset of monsoon. But overall, we are seeing the automotive industry to have a good growth.
Okay. And as you mentioned that raw material prices are softening now, so what kind of decline you expect in the raw material cost in third quarter versus the last quarter?
See, the average increase in the raw material prices are expected to soften in Q3. So that's what we are expecting, and I hope that this type of sustenance or the softening will happen going forward.
So you mentioned you expect a softening or you modest increase in the third quarter?
No, I said softening in the coming quarters, quarter 3 onwards.
Okay. And lastly, on the net debt side, how it has moved versus March? How is net debt at console level now?
Sanjeev ji, if you want.
Yes, sir. So in fact, on the debt side, as we have been repaying our scheduled debt as we have committed, so there has been a reduction to the extent of about 250 crore rupees on the long-term debt side. But on the parallel side, on the working capital, in fact, there is a slight increase in borrowing because of increase in the raw material prices, the finished goods prices, and there was an increased requirement for working capital to grow our business further. As you would have noticed that there has been a very good growth which is coming in terms of the revenues. So there was a requirement for increased working capital. So to that extent, we have been actually on overall debt side, we have been almost at par with the number which was there in the month of March.
Okay, but if the RM prices come down going ahead, in that case, can the working capital come down?
That should help in reducing the working capital going forward.
Okay, thank you and all the best.
Thank you.
Thank you very much, sir. We take the next question from the line of Neerav Saxena from Living Root Capital. Please go ahead, sir.
Yeah, hi, sir. So could you mention the price hike taken during the quarter?
During the quarter 2, the average raw material price increased by 4%.
And so what about the price hike we have taken?
And the impact on the selling price was 3%, but we were able to take a price increase mitigating that 3%. But having said that, in the last 7-8 quarters, we have witnessed an unprecedented raw material price increase and the under recovery to the extent of 7 to 8%, which we would try to recover by restoring our product price increase, which we have been doing, and our focus and thrust on operating leverage and even efficiency improvement and cost reduction measures and several other measures for including product premiumization.
So, sir, if you are mentioning that the price hike taken by us in the quarter is around 3%, if we look at quarter-over-quarter sales of the company, the sales have increased by 3%. So, could we say that there is a negligible growth in terms of volume then?
Well, our growth in terms of volume has been 15%.
So I'm talking about quarter-over-quarter, not year-over-year.
As compared to the corresponding quarter. As compared to the previous,
it is same flat.
So I'm talking about Q2 compared to the Q1.
So the volume growth has been flat only.
It has been remained flattish. So, sir, is there any specific reason behind the flattish growth? Because as you have mentioned over your commentary, OEMs are picking up, so the volume growth should have been increased.
I would request Anuji, would you like to take this?
Yeah. So, generally for the tire industry, quarter 2 is a slow quarter if you take the previous quarters. So, as compared to quarter 1, this year I think so, if we have been able to maintain the volumes, it is actually a good demand, a good sign. And the demand from OEMs has been very strong, especially in the month of September. So going forward, because in quarter 2, the mining and the road construction activity slows down because of the monsoon. There is the general sentiment is also not very strong. So generally quarter 2 is slow, but this time I think so quarter 2 has been equal to quarter 1, which is a very good sign.
Okay. So to follow that up, are we providing discounts in the market to push the volumes?
Not really. In fact, we have been taking price increases, but again, segment to segment, there may be certain special incentives or schemes, but other than that, there are no major discounts as such.
Okay. And so one more question. So what is the reason behind increase in inventory, whereas OEMs has been picking up?
Could you repeat your question, please?
Yes. So what is the reason behind increase in our inventory, whereas OEM sales have been picking up in general?
Yeah, so basically overall inventory may have gone up slightly. There was a specific reason because a couple of OEMs, they had faced certain, they couldn't pick up the stocks because of certain order postponements from the export market. But that is all very useful inventory, which actually has got liquidated even in the month of October. So there's nothing, no reason to worry about that.
Okay. And so the last question, so if we compare our other expenses on a year-on-year basis, on a half-yearly figure, the other expenses have increased by 22%. So what is the reason behind it?
So other expenses have increased by, what is your point?
22%.
22%.
22%, yeah.
So I think the production levels have also gone up, and if you are comparing with the corresponding quarter, in fact the production which was at almost about 90% plus, because the radial capacity, as I mentioned, was almost at the peak of the utilization levels. So this is one reason that the production, whenever the production goes up, other expenses also goes up accordingly. But not to that extent in some of the cases, of course, because these are semi-fixed kind of expenses which may have come down, but that expense have gone up. And also the power and fuel cost may have gone up because of the increase in the fuel cost.
Okay, so that's primarily the reason behind increase in other expenses on a half-yearly basis.
Yeah, but revenues have got up at a higher rate.
Okay. Thank you, sir. That's all from my side.
Thank you, sir. We take the next question from the line of Mr. Sumam Agarwal from Equitas. Please go ahead, sir.
Yeah, thank you for the opportunity. So my first question is slightly long term.
I'm sorry to interrupt, Mr. Shubham, but there's a background disturbance from your line.
Just give me a second.
Hello, this is fine?
Yes, sir. Please go ahead.
Yeah. My first question was slightly long term. So I wanted to understand that when the tire industry will go up the technology curve, whether it is related to electric vehicle or the enabling of labeling norms by government going ahead in the future. So how does this impact the overall capacity of the current capex, current assets that we have? So I just wanted to understand a bit more around that.
So, as you know that now the automotive industry is going through a transformation which is into EV vehicle, and there are a lot of models being introduced in the short term and the long term. There will be a lot of models introduced by the manufacturers. Here at JK Tyre, as I told you that we are already launched our EV product lines in various categories, in the truck, passenger and commercial categories. We've already launched that. So that is the technology and innovation which we are harnessing, and in the near future this percentages in terms of EV will go up.
Yeah, so I understood that point, but the thing that I want to understand a bit more is our current fixed asset is capable of producing a certain kind of tires, right? And as we go ahead in the technology curve in terms of EV, the new launches that we are doing, how does it impact our asset, or how does it reduces the productivity from current level?
No, the assets which produces our EV tires, with those assets will not have any kind of shortage in terms of impact on the tonnage or numbers.
Okay. So
and just to add, for your information, which we have already shared, we have two capacity expansion projects that are undergoing, one for TCR and one for TBR. So these capacities would also have the latest equipment and technology. So there will be no gap in terms of producing the EV tires or the low RRC tires or the green tires.
So we are not seeing any redundancy of existing assets?
No, not really.
No, not really.
Okay, got it. Noted. And secondly, just wanted to understand on the volume growth part. So YOY volume growth, how much did you mention?
So compared to the corresponding quarter, we had a 10% volume growth.
10% volume growth. Okay. Okay. Yeah, that's it from my side. Thank you so much.
Thank you.
Thank you very much, sir. We take the next question from the line of Mr. Jinesh Gandhi from Motilal Oswal. Please go ahead.
Hi. My question is on volume growth. So of the 10% volume growth, can you give a breakdown between how did volumes grow between OEM and replacement on YY basis?
1 second. 1 second, please. Hold on.
Sure.
No, we don't have the figures, but what we'll do, we'll get back to you.
Okay. But broadly speaking, OEM would have been more or less flattish to marginal growth, and replacement would be flattish to marginal growth, and OE would have grown faster. Would that be the direction?
Generally, what you're saying is correct, and that the OEM growth, because of the lower base of last year, would be higher. But we'll get back to you with the exact.
Sure. And second question was on the replacement market trend. So over last couple of quarters, replacement demand had started to moderate on a high base of last year. So are we seeing any signs of recovery in TBR and TBB as well as PCR now?
Yeah, so all the segments are kind of showing signs, but as I mentioned earlier, Q2 is generally a low quarter because of the monsoons. But this time we have seen a very steady demand in the replacement market as well. And we at JK Tyres have been doing consistent business throughout the quarter, month on month.
Okay. And lastly, at Tornel, we are operating at over 90% capacity. So do we see a need to add capacity there as well, or we would be servicing that market through the capacity expansion in India? How are we seeing that?
Look, we have already taken up, as you just heard my colleague say, that we are on an expansion in terms of PCR and TBR. And similarly, we are also planning some expansion in the Mexican plant, JK Tornel plant. But for now, the capacities that we have are completely taking care of the market, including the slight growth that is taking place in 2022. So going forward, we don't see any gap in the demand versus supply.
Okay, and this expansion at Tornel would be more of a debottlenecking exercise, I believe.
That's right. Absolutely. You said it.
Okay. Got it. So broadly speaking, our capex plans are more or less similar to what we indicated in first quarter earnings call of 1,100 over next 2 years.
This is on track. As far as the expansions in India are concerned, that is absolutely on track, and we will be able to complete the project as we have announced earlier.
Got it. Great. Thanks and all the best.
Thank you.
Thank you.
Thank you very much. We take the next question from the line of Mr. Mitul Shah from Reliance Securities. Please go ahead, sir.
Congratulations, sir, for very strong performance, and thanks for giving me opportunity. Sir, one clarification on your long-term debt. There is, as per this exchange filing, it's almost flat versus March versus September. In March, it was 2476 crore, and recently it is 2470 crore. So you highlighted that we repaid 200 crore. Is it after September, or what is the detail, sir? Yes.
No, so actually I was referring to the scheduled debt which has been repaid to the extent of about 250 crore as per schedule. So that has been repaid, but because as we have also undertaken the new expansion, so some bit of the new debt is getting added, not in the form of long-term debt at the moment, but at least in the form of, let's say, the sort of these LCs and buyer's credit and supplier's credit, those kind of things are getting added. So this is to be considered in the long-term borrowing.
So this is in addition to what we have increased in on working capital debt side also, right?
Yes. So the net impact is the net debt as on 31st of March was 4940, and as on 30th of September this was about 5,000 crores. So roughly around the same level, but yes, there has been an increase in the short-term borrowing to the extent of about 200 crores.
It's a second question on OEM revenues, sir. If I look at your standalone business or India business, it is almost flat quarter on quarter, first quarter versus second quarter. Whereas if we adjust for this 2 or 3% price increase, then there is a decline in volumes of OEM compared to overall production level has gone up by 20 to 25%. So are we losing market share, or what is a major change in mix? Why is it so?
OEM, actually, we have increased our revenue in the volume. We have increased our volume, and particularly, as I told you, that in the CV market, where the CV vehicle has started coming back, there we have really increased our percentage share.
In terms of revenue, it seems flat Q on Q compared to industry volume going up by 25% between the quarters.
See, actually, if you take you're comparing with the previous quarter, right?
Right.
If you compare the revenues with the previous quarter, in the replacement market, we are up by, say, 3 to 4%. And in the OEM, yeah, there is almost, it is flat, or maybe minus 1 or 2%.
Yeah, because production level has gone up by 24% between the quarters. OEM production.
OEM production.
OEM production, you mean the automobile industry production, right?
Yes, automobile industry.
Okay. You are talking about the OEM production. So within the OEMs, you will have to also see which OEMs we are talking about, because in terms of value, our major revenue comes from the commercial vehicle. So there I don't see that the production has gone up to that extent. And also being the half-yearly closing, they would also like to correct their stockings position in their raw material inventories.
But if we compare the H2 corresponding quarter, H2 to H2 FY23 to FY22, their corresponding quarter in terms of revenue from OEM, we have increased to 38%.
Yes. So exactly similar question on other segments also, wherein there is a decline of around 10% on a YOY basis, year on year. So is it to do with the volume, or there is a major change in product mix? And I believe this segment being a high margin segment.
Mr. Shah, can you please repeat your question? Which 10% reduction you are talking about?
Other segment, that is OTR and other FEAs and all that segment, where our revenues have declined by 10% YOY, corresponding quarter last year, sir. So is it to do with the volume, because we must have taken price hike, or there is a major change in product mix?
Yeah, so your observation on that OTR, but that was a very specific one order that we had serviced in the previous corresponding quarter, and in this quarter that order was not there. So that has impacted us, but I don't think so that is such a big cause of any worry for us.
Okay. So lastly, if you can give details on Cavendish in terms of volume, revenues, margin or profitability, and what would be inter-segment revenue here?
So, okay, I'll just give you about Cavendish. So Cavendish has, of course, been doing well, and the revenues have grown in the case of Cavendish as well. Yeah. So in Q2 FY23, the net revenue turnover was registered at 982 crore with an EBITDA margin of 6.3% in the case of Cavendish, and the PBT was minus 18. So this was slightly a loss on account of some foreign exchange losses.
So what was the inter-segment revenue?
The top line has grown as compared to the previous corresponding quarter to the extent of 34%. So there has been a growth in the revenues in CIL in this quarter.
Inter-segment revenue, sir, JKI.
Which?
Inter-segment to JKI, we sell some portion to
Intercompany revenue has been to the tune of about 200 crore from CIL to JK Tyre. Inter-unit transfers, that is what you are referring to probably.
Yes.
Right? So 200 crore rupees of revenue from CIL to JK Tyres.
Thank you, sir, and all the best.
Thank you.
Thank you very much, sir. We take the next question from the line of Mr. Ameen Pirani from JP Morgan. Please go ahead, sir.
Yes, thanks for the opportunity. My question is actually on the anti-dumping duty on Chinese truck radials. As we understand, the duty was supposed to expire in September of this year, and it has been put on a review. So any indication as to when we will hear from it, and any indications from the government whether this could be extended or what could happen going forward?
So the duty has been extended right now till December 2022, and the government is still right now under review.
Okay. So we don't have a final verdict yet on the same beyond December.
No, not yet.
Okay. Thanks for the opportunity. I'll come back in the queue.
Thanks.
Thank you, sir. A reminder to all the participants, anyone who wishes to ask a question may press star and 1 on their touchtone phone. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. We take the next question from the line of Mr. Noel Vaz, Asian Market Securities. Please go ahead, sir.
My question has been answered. Thank you very much.
Thank you, sir. We take the next question from the line of Mr. Pushkar Jain from Joindre Capital. Please go ahead, sir.
Hi, sir. Congratulations on good set of numbers. My question was, our raw material basket as a whole, how much has the price softened in terms of percentage, if you can give any clarity, and if you can give the per unit prices of natural rubber and synthetic rubber currently?
So this is what we have been noticing of late in the last about a month or so, that there has been price softening in the raw material prices. But in terms of the exact percentage, because this is a basket of various commodities, so we have still to compute in each of these commodities how much, because we have the accumulated inventory as well, and the average cost is coming out to be the almost like very small reduction at the moment till September. So we will let you know next quarter what it is looking like.
And sir, it can give me natural, like in Q1 call you gave the prices of natural rubber, synthetic rubber. So can you give me the current prices of the same?
Difficult to comment at this point in time. This is too early to comment because the prices for all these commodities have been quite volatile. So let's see for some more time and then we will comment on it.
Okay, sir. Thank you so much.
Thank you, sir. We take the next question from the line of Mr. Jatin from Invest Savvy. Please go ahead.
Sir, you have mentioned that the raw material prices impact, while they have softened, in Q2 the impact wasn't fully realized, partially I guess because you have inventories and partially because the softening started. So given that there was a price increase and subsequent price increases are there, and on the other end you have seen softening of rubber prices and others, where do you see your margin going to in Q3 and Q4? Because historically operating margins have been up to 15-16%, and currently they are at around 8%. So where do you think they will settle down in Q3 and Q4?
So I think when we talk about the margins on long-term basis, we have noticed that the average long-term margin is in the range of about 11 to 12%, right? Except for the financial year 21, which you are referring to, where the margins had shot up to about 15 to 16% range. So we are happy to again, of course, register those kind of margins, but at this point in time, I do not know how the markets will behave in terms of the raw material prices, and because the crude is also quite volatile, as I just said. So I think we should notice and we should get some improvement in margin going forward, but how much it would be, it is really difficult to comment at this point in time.
But I would like to just add here that because of what we are seeing, the softening of the raw material cost side price in going forward in Q3, and we are hoping that it will remain at a softening or stabilizing at Q4. The margin will slightly better. I would say the margin would slightly better from Q2.
And the demand remains robust.
Would you say that by the end of the year, it is likely that you would be close to your long-term margin plans?
Very difficult to estimate at this point of time. It is very difficult to guesstimate at this point of time, and keeping in view the volatility, as Sanjeev has already mentioned, the volatility of the prices of raw material and what we have already gone through. I think, but as MD has said, that we look to a improved scale of margins in the two quarters, Q3 and Q4.
Okay. Fair enough. Also, in terms of whatever expansion plans which are there for capacities, what is the plan to fund them? And also, is there a plan, like while we appreciate that long-term borrowing has been reduced, but since the short-term working capital requirement kind of offset the same, so is the company happy to let the debt, one, how will you fund the expansion plans? And two, where do you see debt going from here? So is it that long term will keep reducing and working capital could possibly take the up, or take the space created, or because of expansion overall debt goes up, or you see it, a conscious effort to bring it down and like force it to slightly more or rather lower levels?
Well, so we have, first of all, we have been fully focused and committed to reduce our long-term debt going forward, right? And even on the working capital side, we have been controlling it in a best possible manner, but because the raw material prices and the finished product prices have gone up significantly in the last 1 year or so, so that is the impact which we have noticed, even for the reasons of sales increase in the volumes also, that is getting reflected. But still, the levels of working capital has not gone up as had been the case earlier. That is one. Secondly, we have been funding our projects in the ratio of 1.5:1, means 1.5 is debt and 1 would be the internal accrual. So to that extent, and because we have been repaying our existing debt continuously to the extent of about 500 to 600 crore rupees every year, so there will not be any net increase in the borrowings in long-term debt, so to say, and there will be a reduction over the period of next 3 years, as we have already said in our previous calls also, that we are expecting the total debt to go down by the year 2025 to the extent of about 40%. So I think this will continue to be there, and the total amount of debt because of the new projects as of now will only be an addition of about 500 crore broadly.
So I think with the improved margins as mentioned by MD in Q3 and Q4, it will give us some leeway to achieve both the objectives of debt reduction and part funding of the capex by way of internal accruals. I think it will give us a good leeway as we go along.
Okay. Thank you. Thanks a lot.
Thank you very much, sir. We take the next question from the line of Mr. Aditya Soni, individual investor. Please go ahead, sir.
Hi. I just wanted to know the demand outlook for quarter 3 for the Indian operation, especially in the truck and bus segment.
Demand growth you are talking about, right?
Yeah, just the demand outlook for quarter 3.
Sorry, your voice is not very clear. Can you please repeat to have a better understanding of your question?
Yeah, I just wanted to know the demand outlook for quarter 3 in respect of the domestic business.
Sure. Demand outlook.
For the CV segment.
Yeah, there was an earlier question on the same, but I'll repeat that the CV is expected to do good and benefit from structural upcycle over the near to medium term, and the CV market has started picking up as you would know that the core industry like cement, mining, steel industry has picked up and infrastructure. So on that we are expecting that CV market will be more buoyant in the coming quarters.
Right. So this is in respect. So could you just give us the split as well, like in terms of replacement market and OEM as well? Like how do you expect both of them individually to grow?
You're looking for the overall, or you're looking for CV in specific?
The CV in specific, sir.
CV in specific, replacement is definitely higher than the OE. I think so it could be a ratio of 1:2.
No, in respect of the growth outlook, sir.
Yes, the growth. I think so in OEM we can expect better growth because it is on a lower base of last year. Replacement market would be better than Q2, but the growth rate would not be as high as what we would see in OE.
In fact, as per one of the reports of a leading rating agency, very recently, which was published, the CV industry, which was peaked at about in the year 2019, that is likely to get repeated in 23 as well, 23 and 24. So this number of about 1 million, according to their assessment, 1 million number on automobile side, including the LCV and the MSCV. So that number is going to be repeated in the year 2024. So we are seeing a good growth actually in this financial year as well as next financial year.
And also just to add, especially in the M&HCV segment, the vehicle or their product mix has gone for a higher tonnage, so that the number of wheels or the number of tires per axle per vehicle has actually gone up. So that is a good sign for us.
Right, sir. That's it from my side. Thank you.
Thank you.
Thank you, sir. We take the next follow-up question from the line of Mr. Neerav Saxena from Living Root Capital. Please go ahead, sir.
Yeah. Hi. So could you also comment for the increase in exceptional items?
Exceptional items, right? So that is because of the foreign exchange losses. In fact, because as you would know, there has been a steep appreciation of dollar vis-a-vis rupee in this quarter to the extent of about 3% within the quarter itself. So to that extent, we had to reinstate our foreign exchange loans, and these are all mostly the unrealized losses, and these are mark-to-mark losses, which we have to book in our accounts as per the accounting standards and the accounting guidance notes issued by the institute. And I believe that once the rupee starts, let's say, strengthening vis-a-vis the dollar, as the guidance given by the bankers and experts, is that the dollar will dollar-rupee parity should be in the range of about 80 to 82 by the end of the financial year. Some of it will come back. So this is just a reinstatement for the purpose of mark-to-market the outstanding loans.
The accounting standards require all the dollar liabilities to be stated at the rate as prevailing on the last date of the quarter. As Sanjeev has said, I think going forward with the expectation of the rupee dollar parity to be slightly better, I think we'll see how it moves on. But these are all unrealized. These are no cash outgo or anything. This is still when the payment dues, when they come, then the actual payments will be made. This is only to record the values as on the last day of the quarter.
Absolutely.
Okay. Thank you, sir. That's all from us.
Thank you, sir. We take the next follow-up question from the line of Mr. Mitul Shah from Reliance Securities. Please go ahead, sir.
Yes, sir. Thank you for follow-up opportunity. Sir, I have a question again on your CapEx, cash flow and debt. So as you highlighted in earlier call also, CapEx of roughly 1100 to 1200 crore for 2 years, that is nearly 600 crore annually. So in first half, we spent around 200 crore CapEx, so roughly 350, 400 crore CapEx is yet to be spent in second half. Also, we are indicating 400, 500 crore kind of a debt repayment, which remains flat right now. So if I do this math, it's coming 800 to 900 crore kind of a cash flow generation from operations in second half compared to what we generated nearly 400 crore in first half. So I'm not getting how will...
No, so this will be, Mr. Shah, partly the loan, this project will be funded through loans as well, right? So 60 to 40 is the ratio, 1.5:1. So whatever internal accruals are required, that of course we will be in a position to generate. And in fact, just to give you some more comfort, in the first quarter, I think we mentioned it earlier also, we had received some 200 crore rupees of outstandings from the government against the GST and export incentives and all those things. So that cash is also made available to us. So we don't see any challenge as far as the cash requirement is concerned to fund these projects. And because the loans will also get disbursed, so everything will fall in place.
So based on that calculation, roughly our net debt can be slightly higher, maybe around 500.
No, but this will get divided. So 766 crore rupees of the capex, which will get funded in the ratio of 1.5:1, and the 300 crore rupees is the maintenance capex provision, sort of provision or announcement which we have made. This could be plus minus any number. So 300 crore rupees for the maintenance capex. So for that, of course, we will also raise some amount of debt, but net debt increase will not be as much as what we are going to repay in the next 2 years period, in FY23 and in FY24.
Okay. And so lastly, if you can throw some more light on Mexico industry, tire industry in terms of this replacement, which segment within that or which products are doing well and our market share trend and what is the potential there?
Mexican industry, the requirement in terms of, let's start with passenger car radial, the PCR tires, is the growth is reasonable, and we are growing at the rate of something like 8 to 10%, and that will continue. And for that, our market shares are steadily increasing. We are inching up, and that will continue at least for the next 2 to 3 years. Beyond that, I may not be able to tell you at this point of time. And in terms of the truck bus radials, also the market is growing, albeit a little lesser than the passenger car radial. and there also we are not manufacturing truck bus radials in Mexico, but we are feeding the market by getting tires from India as well as from our other outsourced partners. And of course, the truck bias tires, the market is certainly degrowing, and to that extent, we are now in terms of expanding into or diversifying into industrial tires as well as into farm tires. So that is the situation. But overall, the growth in the Mexican market is quite reasonable. In fact, I would say it's good.
Sir, how has been the pricing there? How much we have taken increase in Q2 and first half?
Overall, I would say that the price increase taken in Mexico is roughly about 16% in the whole year of 22 and 20. Let's say last 15 months, we have taken roughly 16%, and which has been more or less enough to cover the increases. But if we are able to take another 1 or 2% going forward, then I think we'll be a little more comfortable in terms of our operating margin.
Okay, sir. Thank you. All the best.
Thank you very much. Ladies and gentlemen, that was the last question for the day. I would now like to hand the conference over to the management of JK Tyre for closing comments.
Thank you very much for joining us on this call, and we hope we have been able to reply your questions to your satisfaction. I, on my own behalf and on behalf of JK Tyre, once again thank you everyone. Thank you.
On behalf of ICICI Securities, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.